Now, you can't figure out where you're going to go unless you figure out where you've come from or others that are somewhat similar. If we look back at the Japanese markets, they have some similarities to the US. They have they did last year, and they still kind of do. However, it would be important to emphasize that when the Japanese markets went bust, they did have a real estate bubble, but they also are limited in terms of what they can do. They had huge innovation in technology, and they've kind of taken somewhat of a sideways approach. Other markets have caught up to them. They've got an aging population. They've got some disadvantages that, frankly, the U.S. does not have. But since 1985, over the past 24, 25 years now, the Nikkei performance depicts a grim picture of the stock market of a country which has been burdened with debt and minimal growth. Right now, if you look at Japan, they're still kind of in this same phase. After the big tank in 1990, it seemed to have bottomed in 92, and it didn't. From 92 through 2009, and now we can even fast forward that to 2010, despite having 3 great years when returns exceeded 25%, the index is still trading below its 1992 low. Now, PIMCO, one of the largest dealers in bonds, is calling for what they call the new normal. The new normal to them is slower growth across the board. Slower growth specifically in the US, in Europe. The emerging markets have some good growth opportunities, but it's just going to be a new normal. In other words, GDP growth of 3%, 2%. They're anticipating, as the largest bond dealer in the world, slower growth going forward. And that's because they're burdened with debt and minimal growth opportunities here in the US, just as Japan was back then. Now, they had some clear disadvantages, but the biggest risk to our markets going forward is still deflation. Deflation is when prices go down and demand still does not increase. In 2008, as oil prices were getting hammered to the downside, was there a huge pickup in demand for oil? The answer is no. There was not. In fact, oil prices went from their peak at $147 a barrel down to $100. It slid through $100 a barrel like a hot knife through butter to the 90s, 80s, 70s, 60s, 50s, 40s. You get the idea. Finally bottomed at 40 some odd dollars per barrel for a barrel of oil. So the point is, when prices are going down and demand still does not increase, that's deflationary. That happens when you are burdened with a lot of debt, and you basically take on a lot of debt, and you have slower periods of growth, and it takes time to dig yourself out of this hole. I always compare this to, what the US is doing by taking on more debt. It's basically saying, okay, we own 3 properties. We rent these properties out, and we can't make our payments. The rental income is not paying them off. So what do? We go buy 3 more properties so that we can collect a little more rent, and now we can possibly get out from under this. Now we take on more risk, but we can possibly bring in enough cash flow to kind of work our way out of it, and then when things recover, we'll sell some of those properties off. That's kind of the philosophy that we're going down is, hey, we're going to print our way out of this. We're going to make sure that there's inflation. We're going to make sure that there's demand, whether we have to just pump dollars into the system to get us to grow. We're going to cause that to happen. And then once it starts to happen, then we'll start to work our way out of it. Then we'll start to sell treasuries and so forth. So the Fed is battling against this risk of deflation by pumping money into the system. They do this through the purchase of treasuries and other securities to keep rates low. Some would argue artificially low. Can they slow inflation once it gets started? We last year were extremely bullish on precious metals because of what the Fed had already instituted, and they hadn't even started QE2 until basically they announced it late this year. QE can create jobs, and that's one of the factors they're trying to do is, hey, if we pump money into the system, then companies will start hiring more people. Then those people will be productive in the markets. They'll spend money as the economy recovers. Again, they'll be able to work themselves out of it. But it's through debt that they're doing it. They can spur on economic growth. Improvement has been seen in the GDP numbers. Wall Street has raised estimates by, on average, about 1% for next year in US GDP. Goldman Sachs and JP Morgan and other brokers have raised their GDP estimates here, actually relatively recent. It was about, I want to say, about 2 weeks ago or so that most of them started to raise their outlook. Let's look at some 2010 data. Here are the sources that we pulled this data from. So you can see labor statistics, economic analysis, National Association of Realtors. First, jobs, pay, and inflation. Here's where we're at. We're at 10% unemployment. Now that 10% are basically, according to government reports, that's the unemployed. Now, there are other ways to calculate, and some would say that the real unemployment rate is, 15% or 14% because some are not claiming to be unemployed and so forth. But anyway, 10% unemployment. Here is the number that have been unemployed for more than 6 months. So we are at above 4% of unemployed for over 6 months' time. That's probably the more damaging number in terms of long-term unemployment. If you're long-term unemployed, more than 6 months, for many people, they're not going to be able to retain their home and other things like that. So that can be kind of the more dramatic number there. As we look at unemployment rate by education, less than high school, if you don't have a high school diploma, 15%. If you graduated high school, 10%. If you have some college, call it 8%. If you have a 4-year college degree, 5% unemployment rate. So obviously this would, colleges would like to see this displayed everywhere. Get some education, get some knowledge, you're less likely to be unemployed. Let's look at pay. Pay actually went up this year, nominal pay. Consumer Price Index, which measures inflation, odd the way they do it. They take out energy and food prices, which are what most people pay and what are inflationary. But you can see that if you exclude food and energy, there hasn't been too much inflation. There has been a little pickup in real weekly pay. If you look at energy, we had a big dip and now we've rallied, and energy prices have gone up about 3% thus far. Most are anticipating a little more out of that. Let's look at profits in corporations as a percentage of GDP, and then we'll look at stock price action, well, price to earnings ratios. And if you look at this, okay, as a percentage of GDP, corporate profits are around 11%. If you look at the cyclically adjusted stock price to earnings ratio, we're in the 20s. Okay, so a little more expensive than they have been over the past 50 years based on this measure. Housing, new and existing home sales, we had 2 large spikes up here, and that was due to obviously the tax credits of this year. As tax credits went away, then we continued our downward trend. So home sales rose as people took advantage of those tax credits, but that's basically it. Then they slumped once again. That's for new and existing home sales. You can see that we really topped out back in 2005, and it started down from there. Now, healthcare, premiums for family and health coverage, you can see adjusted for inflation. Here are your costs. And you can see the number of people that are without health insurance for at least part of the past year, 25% or so. Those for more than a year without health coverage, call it 17%. So you get an idea of things that are impacting the markets right now, where we're at in 2010. Housing's a problem. We have to figure out how to get out of the housing dilemma. We can at least agree probably that housing has stopped its collapse. but it's not recovering really either. Now, here's a look at the markets in terms of averages. The average length of a bull market is around 5 to 6 years. That's a pretty good length of a bull market. You know, some will stop at 3 or 4, obviously, and some might last 7 or 8. But that's our averages. And then if we break that down further and we say, well, what are the average gains in each of those years in a bull market? Well, the first year is the most impressive at a 38% upside. Now remember, that's coming out of a bear market, that's coming out of downward push, so the snap back is going to give you a nice amount of upside. And that's taking from the lows up to the highs of that year. So that's a nice big gain basically from wherever the bear market stopped, and then that first year of upside move as the bull market is brand new, 38%. Year 2, 11%. Year 3 is pretty lackluster at 3.9. And then if it continues, this is kind of like, you know, if you live to 65, you generally make it to 85, that philosophy. If you get to 4, you're strong. 5 and 6, roughly the same. And then the market stalls out and reverses back into a bear market. And that's just historically. We do think this process is going to be sped up. Anytime you're taking on debt, everything's more volatile, okay? I would assume that if you have a lot of properties and a lot of debt, then you feel nervous and you probably have a lot of stress in your life. And those things are not real, you know, conducive to nice, mellow, sustainable type of feelings. You're a little more volatile, and that's kind of where the market's at. All of these are sped up. So if the average bull market is 5 to 6 years, I'd anticipate that now going forward for a number of years, they'll last maybe 4 or 5. Okay, everything just gets a little bit more volatile, and you speed up the process. If we look at bear markets, the average bear market's only a couple of years in duration, but they're violent. As they say, the market takes the stairs up and the elevator down. Average losses in each of those years, big drop in year 1, big drop in year 2, and then markets recover, and we go from there.